All right, ladies and gentlemen, I know it. You've heard it. The sky is falling. Rates are going up. The mortgage companies are imploding. Wells Fargo shutters its doors. But wait, is there good news ahead or more bad news? We're going to find out next from the man who knows. 30 years in the business, president of Success Lending, all the way from Schaumburg, Illinois. Shaun Patrickus, next on Cliff's Notes. Real estate agents, are you struggling with the day-to-day grind, dialing for dollars, putting in hours of floor time with little to show for it? Are you looking for tips, tricks, and tactics to accelerate your career as an agent that will have you closing more homes, working with more clients, and earning more money than ever before? Hi, my name's Cliff Freeman, and I've spent the past 2 decades of my real estate career running one of the top brokerages in DFW and personally coaching over 1,000 high-performing real estate professionals across North America. I created this podcast to share the strategies and tactics you need to explode your real estate business. I guarantee it. Bienvenidos al Cliff's Notes, señores y señoras.
Hola,
Hola,
senor.
It is that time, isn't it?
Yes.
Thursday. Happy Thursday. You guys know what time it is. We're here to change your lives today. That's right, because there's fear of a mortgage meltdown. The housing market is going to crash. Oh my gosh, I'm hearing everything.
Crash?
Yeah, like burn, crash and burn. Or bubble and burn, something like that. Many of you out there in the audience are thinking, what's the Fed going to do? Well, we're going to find out. We're going to reach out to the man who knows more about this than we do. President of Success Lending. Let's bring him on, Mr. Shaun Patrickus, our dear friend in Illinois. How are you, sir? Welcome to Cliff's Notes.
Cliff, thanks for having me. Great to be here.
Well, we are super excited to have you here today, Shaun, and man, I'm telling you what, this is one of those times where having you on the show, I think, could potentially bring a lot of the tension and the nervousness out of the market here as you're able to reveal some of the truths about what's really going on out there. And you know, you have such an acclaimed career in the mortgage business. My goodness, all the way from Countrywide to Stearns Lending. You and Glenn Stearns just have done leaving an incredible mark on the mortgage business, and now you've got your plans set on Success Lending, and boy, you guys picked a heck of a time to start a mortgage company with all the crazy stuff going on. But you are actually crushing it. Your position now to really, really benefit as we go through some of the headwinds in the market to come. So I want to just really cut to the chase here. Shaun, and you're the one that you're my guru, right? I mean, I look to you for advice on mortgages and really just as far as when we talk strategic planning, we're talking very closely together about some of the things we're working on. But I would like you just to give us, if you would, what is your take? I mean, gosh, Wells Fargo, they're talking about potentially pushing the economy into a recession. Is that good or bad for mortgages? What's your crystal ball telling us about the future right now?
Yeah, I think the Wells Fargo topic is one. I mean, that was on the heels of Finance of America, shuttering their core mortgage business, and so I think there's a couple of different things going on, and I know there were some smaller mom and pop shops out there, but that have unwound in recent months. But I think the Wells Fargo is really specific to Wells Fargo. They recently had a new CEO join, and I think the bank, probably their core function is banking. They're certainly a top 4 or 5 bank in America, and they even have a global position. I'm sure they wanted to focus more attention on banking instead of mortgage. They were a top mortgage lender, and so that's probably the first reason. The second reason is they've had just a lot of regulatory turmoil, and I know they had a CFPB fine or refund required. I think it was a really big number, like $3.7 billion. So a significant debt they have to repay. And I think that was announced in December of last year and probably had been pending for a while. So I'm sure they had the opportunity to speak amongst themselves. But the real big reason probably is just that margins are compressed as rates go up. Margins compress in the mortgage industry, and typically as rates go up, volumes go down. And so Wells has been leading for a long time, and I think technologically and from a cost perspective, there's just a lot of newer companies out there doing a better job at manufacturing mortgages at a lower expense rate. And when you have a regulatory bullseye on your back and you're running high expenses in a compressed margin environment, I think maybe the smart move would be to back away from it and focus on their core customers. And I'll just note they got out of their wholesale business last year or the year before, and they're getting out of their third-party correspondent business. A lot of their regulatory problems came, I think, from the CFPB and on loans that they didn't originate, that they bought from somebody else. And so the bank probably just looked at it and said it's not worth it. It's not worth the 8 or 10 basis points we're making on this stuff right now for the regulatory expense.
Right. Interesting. Does that create opportunities or problems for the mortgage business now?
Well, it might create some problems just because Wells had such a big stake for funding loans, but it's quickly, there's a list of banks out there and mortgage companies that will be eager to pick up that space, for a long haul. And, I won't name any names, but there's probably 3 or 4 of them out there that'll be glad to pick up that market share because they started later, their technology's newer, their business process is more refined. They're going to just become more profitable by picking up that volume. And with technology nowadays, you can service so many more people with the right technology in place that they'll benefit from this opportunity, these newer companies.
Purchase business is down significantly since last summer. Refis have all but gone away, right? Except for probably cash outs for some folks. But Shaun, I know you're excited about the mortgage business right now. What gets you out of bed every morning?
Well, I'm very thankful to be, building the success lending for EXP and the relationship with EXP, and any chance you can be surrounded by people like Mr. Glenn Sanford and the leadership crew at EXP is a phenomenal opportunity. I think there's a lot of originators out in the marketplace looking to find companies to partner with and work with that have these unique access relationships like success lending with EXP Realty. And I can only tell you that in and of itself is the core of what gets me out of bed in the morning. And then I love this, what I call the soup du jour. Every day there's a new problem in the realty and mortgage financing business. And so there's never a dull moment. And then again, to the zero sum, if we're winning, somebody else might be losing. If I'm losing, somebody else might be winning. I think that's exciting, from a career perspective. It's why I love the business, and I've been in it for, 29 years of my life. So that's my favorite part, I think. Competition.
It's funny. I got I started loans. I guess I've been on the origination side since 2003. So it's been 20 years. That's crazy. And I remember we were having kind of a big refi mini boom at that time. And then I got to witness the implosion 2008. What's interesting on the real estate side, Shaun, there's probably less than, I would say, 1 out of 10, maybe more real estate agents who were around for 2008. And they've never seen a swing in the business. Now, what we have here is nothing like, we'd all agree, nothing like 2008. But what's it going to be like for these new originators or the originators that have only been in the business for the last few years and who, for example, had to build their business on refis and just never learned the purchase business. What's it like? I mean, if you're an originator that was doing really well 2 years ago, what are you doing today?
Well, the business is different, I think, in a lot of ways, but the fundamentals, I started in 95 and I built a business on some key relationships that paid dividends. So if they were doing what they were supposed to on the solicitation side and developing, key accounts and really working on partnership with individuals, which I know everybody on this call has learned the value of partnership, whether it be with the right organization or the right team of people in a local market. Partnering is more than just flipping a deal here or there. It's really working together, holding people accountable together, and planning together. So if they were doing the right things from the beginning, this might not be as challenging of a spot. But I think a lot of people manage to the lowest denominator, or they let the environment manage themselves and they're not leading. So I think a lot of folks were, looking at their phone saying, hey, nobody's calling me on the phone. What am I going to do? And I'll just share a fact. I was listening to an interview with somebody from Stratmore Mortgage Data, and they had an interesting stat. It was in the height of 2020, there was 400,000 plus originators in the mortgage space that were actively licensed, and coming into 2023, there was about 218,000 on the data point. So let's just round it to 220,000. We've seen about 180,000 originators, or about 45% of the headcount of originators, exited the mortgage business. So that's a quick answer to your question of what are they going to do. I think a lot of people are just going to move to a different industry.
Well, that happens. There are shifts anytime we have big changes in the market, and it is, some of these swings are pretty big. I mean, compared to 2008, I mean, there's been a lot of change in the not only the type of business that mortgage companies do, but just the sheer opportunities and volume. Strategically, for the next couple of years, how do you look at what is going on with rates and the economy and the Fed right now? Does this make it really hard for a mortgage company to make any kind of long-term plans? How are you looking at your business right now for planning purposes, Shaun?
So I think, in the moment, and you're seeing this with a lot of companies, I think it's make revenue or revenue plus if you can. Realty and really all real estate, it's sort of a 5-year season, and we're starting a new season. I think people cashed up a lot in the last 5-year season of realty and mortgage. I think in the moment, if you were writing a 5-year plan, I think your goals would be, kind of like Kennedy saying, let's put somebody on the moon. I think you can have an unwritten path right now to a huge opportunity, and it starts today. I think in the next 2 quarters, I think it's revenue plus. You're looking to do a lot of expense management, because we did lose in the mortgage space specifically. We lost a lot of refinance transactions, obviously. The MBA is forecasting in 2023 more purchase than last year, although last year might have slightly higher volume, but you had January, February, March were still really robust with 3% interest rates, so they were robust in the refinance space. So, I think the businesses are really looking at what we can do without. Do we need a lot of the gadgetry that we had when we were making 400 or 500 basis points on a transaction? And right now, to be competitive, you're probably making, with full impact of running the business, maybe 200 or 220 to be really competitive, and the commodity side of it. So, you really have to right size any expenses that are not appropriate to the volume levels where you're at. And I think it makes everybody run a little sharper. The folks that ran having, 5 assistants doing every other job, it probably isn't the market for that right now. You have to, know how to use your saw and sharpen it too. You got to run your business start to finish. But in my mind, I think it's an unwritten canvas right now. If you can get to revenue even or revenue plus just a little bit, and it's a great opportunity. I think everybody's up fair game to talk to. I think I've seen LOs at 22-year veterans at a company moving to a different company right now for different reasons, and I think we're at a point where we're going to see that movement, and I think we can sort of write our own plan from here.
Yeah. Shaun, I have to ask you, are there any potholes along the way here? A lot of the loans that were originated over the summer that were highly leveraged, government loans, for example, FHA 3.5% down, VAs, those loans are upside down now. Are we at risk of seeing an increase of maybe a pop or an increase in short sales or foreclosures in the near future?
I don't believe we will be, but what I would tell you is this. I think it's, first of all, that's by market. So there's some markets that's not really necessarily the case where they're upside down. But what happened is, what's unique to this situation is we had a global pandemic, which 50, 100 years, you have a global pandemic, maybe. I've never seen one in 50 years. But what I would tell you about it is we're running into this situation where if you had a 3% interest rate, we've experienced wage growth over the last 2 years, and wages went up, your expenses went down during the pandemic. We have full employment in America. We're just not seeing this systematic sort of default. There's just no reason for it. And really, so the trade is you get out of your house, where are you going to go? I mean, what house are you going to find that's bigger or better for less? And so the impetus to hold on to what you have is very great from a personal level, from a family level. They wouldn't want to relinquish a house. And we're not really seeing that in the second home market either, ironically, because we haven't seen a real drop in values. And quite frankly, second homes and investment properties have lower loan to values. But although rents are coming down, they were, really high over the last 2 years. So I think most of the folks out there are doing pretty well, and credit criteria had improved from our last systemic failure from the 2000s. Everybody we've been lending to are better qualified, better incomes. I think we really are in a good place from that perspective.
When the two Glens met first, I think it was out on Glenn Sanford's boat, if I'm not mistaken, and they had this crazy idea about putting a mortgage company together, and it's turned out to be a phenomenal success, and for good reason. Would you speak a little bit to the advantages, just say to the consumer, of having two companies that are working, pulling in the same direction to work on a transaction? What's the benefit to the end user, do you see here?
Yeah, I think that's an important distinction to make as to the why, sort of on why we exist. Well, for the businesses, obviously vertical integration is always important. I mean, even Henry Ford wanted to own every aspect of the car manufacturing is really critical. But it's not just for the benefit to the companies. It's really the end benefit is to the consumer. So you've now got some folks that are giving you consultation on your biggest financial decision, whether it be from the realtor or the financing. Everybody's sort of equally invested. We all work for the same business at the end of the day, so to speak, through the layers of ownership, and we're both working to sort of edify each other and really make sure we deliver the best service to the consumer. And it also keeps us very, very competitive. We recently rolled out our Buyer's Best program, which is a $1,500 lender credit to be applied to any closing costs. We do that for loans referred, sale, a buyer list from an EXP realtor, on top of extremely competitive pricing. So, at the end of the day, the mortgage business is slightly a commodity-driven business. You have to be, within about an eighth of everybody to stay competitive. For us to offer even additional closing costs on rebate is a phenomenal opportunity for affordability. And all of those things put together in combination on our partnership really translates to the best transparency to the consumer. And all of our core values are the same core values that apply to EXP, that absolute transparency, answering every question in combination with the business and the transaction. All the fundamentals that make a great buying event for a consumer, it just enhances it with this level of partnership. And again, absolute accountability, because I can get a call from Dave Kennord in a second if we didn't do something absolutely perfect. It's other companies might not answer their phone. You never know.
Or might not be there the next when the phone rings, right?
Right.
I mean, they come and go all the time.
Yeah.
If we can just talk about the purchase side of the business here for a little bit, it's a lot different than the refi side. Refis are mainly just a math problem. It's pretty straightforward. But on the purchase side, you really need a loan officer that's got a good toolbox and is really knowledgeable about the market. I mean, you're dealing with typically the largest purchase that most people will make in their lifetimes, and how they finance it can, mean the difference between, spending or saving literally tens of thousands of dollars over the life of the loan. I know you guys, and we have a wonderful loan officer with whom we work and do a lot of business with. What are you looking for in terms of experience, and what are you guys doing as far as helping raise the bar in terms of the quality of the loan officer that you employ?
Yeah, that's really a phenomenal piece, especially for the market we're in right now. So we're really looking for originators that do the business themselves. I've talked to so many different people, and they tell me they have 3 assistants, and they have a marketer, and they have an assistant that calculates things. And we're not really always looking for that right now. We're really looking for individuals that like to work with the consumer. They like to talk about the financing journey in a purchase transaction, and they want to quarterback the transaction without getting out of their own lane. They focus on what the pertinent things are to discuss, and they're very transparent. And I think that's a unique thing, and it gets understated in the business we're in. We have people out there that really enjoy talking to the consumers and explaining the transactions, and then you've got these high volume folks out there that might talk to somebody about quoting an interest rate, and then there's 3 assistants shuffling them around. We are really looking for people that ran their desk well individually. They know the business, 8 or 10 years. Our average experience is 10 plus years amongst the roughly 52 originators we have already. And we're looking for those folks that enjoy communicating the value of the mortgage business and enjoy that. It's all too often I talk to individuals, they're telling me about how they want to do something other than the mortgage business, yet they're in the mortgage business. And I think it's very interesting to be doing something you don't really want to do. And it happens, I think, in many careers over a lifetime. But I wake up most days thinking, what a great opportunity I have to work in this industry. I enjoy telling my kids I help people buy homes. I have 3 wonderful kids. I can't, they say, Dad, what do you do for a living? I say, I help people, buy homes to live in for their families, just like ours, the one we live in. And I think that's where, when the Glens got together, Glenn Stearns is a relational person and has a deep passion for the mortgage industry. He's been in it a long time. He knows what matters. And I think a lot of those things hold true amongst all of his businesses. I worked in Stearns lending for 10 and a half years before coming to Glenn's business here. And quite frankly, I love the business, and you know, it's interesting when I talk to people, I can tell who likes it and who doesn't.
Yeah.
Yeah.
You know, it's great to hear you talk about it that way because, and especially and it's just a fact. You know, refi. If you're coming out of the refi side, there's really no time pressure to get the deal done. Sometimes, you know, people just keep pushing it and pushing it. When you're partnered with a real estate agent to get a closing done and have a deadline, I mean, the ability to work together to make sure that that happens is incredible. I've really honestly, after 37 years in the business, my mom was in real estate and she had very close relationships with First Federal. Who all was doing loans back then? You weren't even born, man.
No, I wasn't even a thought.
You weren't even a thought. Yeah,
Yeah.
You'd never even yeah.
Yeah.
But it was you know, I mean, because it's such an important part of the whole process. I mean, we say that it's a commodity, but it's a commodity that you have to handle with a lot of care because you can ruin somebody's whole experience and potentially cost them a lot of money just by not doing what you need to be doing to get that loan closed. And you know, I mean, that's the real benefit that we've found here. And you know, for example, Chris, my gosh, he's taken on deals that were blown up and broken by other lenders and was able to get them closed in a couple of weeks. And we love it when we can come in and save a loan. We prefer that doesn't happen. We prefer to get the loan in the beginning,
Right.
because we can ensure that it's going to close on time and so forth. But if you were to, and a lot of consumers don't get this, if you were talking to a consumer, Shaun, tell me a little bit about how would you explain to them why they may not want to use an internet lender, somebody they've never met, versus somebody who comes highly recommended?
Yeah, I think on the recommendation side, it's usually folks that are working together in some sort of a mini team or working in a partnership. We partner our pod of people, and I don't want to use that term pod, but our group. So we have a loan officer, a processor, and an underwriter that works with each loan officer. So they're working with the same people. And you know, if you run your business well enough, we have enough controls in place where we can have those relationships and still do a great job in manufacturing a loan compliantly, very, very well. But I think it's those internal ties at the company where a lot of these bigger businesses are running with so many different operating procedures to protect the customer from the loan officer from the underwriter from the customer. And you know, they create their own traps. And I'll talk to somebody and they pull up their britches saying, well, I work for a company and we have 8,000 people. That means you got to pay for 8,000 people, and they'll only have 1,000 loan officers with 8,000 employees. And you're thinking, I don't know if we need somebody that specializes in screwing in a light bulb to make this business work. I think we're in a contraction phase where we want people that know the business well and they know how to do it. Their reputations are so expensive that they're not going to jeopardize that by doing anything inappropriate, and they're going to think first and put the deal together the right way. You know, I've looked at it, a couple of fun adages I look at in the mortgage business. I say nobody ever recognizes a swept sidewalk. You know, you recognize a sidewalk that's got leaves and gum and cans and debris on it, but when it's clear, you don't remember somebody had to really work to get the business process in such a way where it's green lights when you need green lights, and you're nimble enough to get to people to make decisions. And I think that's very, very important. I'll tell you, I was over at one of my neighbors' houses this last weekend, and he was helping me with my hand. I had a small thing on my hand here, and he's a surgeon. And we were talking while he was doing something to my hand, and I said, well, how do you know if a surgeon's good? And he says, there's three types of surgeons. He said, there's fast and good, there's slow and bad, and really slow and bad. So, you need to think ahead, and you need to know what you're doing in the moment. because you can set yourself up for other problems further downstream in the process. And by being transparent and dealing with those things up front, you can handle a lot of the issues quickly and set yourself up for a great situation. And that's really what we try to do here in every transaction that we're working, especially for the consumer's benefit. We certainly want to close on time for everybody involved, but we want to close on time for the consumer more than anything. We want them to walk away loving everything about EXP and Success Lending.
Yeah. And I not to disparage anybody in the mortgage business, but we have, as a realtor, I can tell you a lot of times money center banks and some of the big insurance companies that do this as sort of a secondary business, they've used their corporate style to divvy things up, and they'll have a loan officer in Phoenix, underwriting will be in Las Vegas, processing will be in Anaheim. Then they'll have a closing disbursement team out of Salt Lake City. And in the meantime, you've got this poor person in Dallas just trying to get, his furniture out of the 18-wheeler, from one house to the other. And 90% of the problems that we see in the real estate business, C3, I know you'll agree with this, are usually with the loans. Yeah. And when you have, you were talking about sort of the advantages of a smaller company versus a large company, man, I think having a smaller, mortgage bank that doesn't have a drive-through window is the only place you should go for mortgages. Just like, if you wanted to go buy ice cream, you go to an ice cream store, right? I mean, right. You don't want to go to Kroger to, it's okay, but if you want a big old Brahms sundae, you're going to go to Brahms, right? Or
Amen.
Or Baskin Robbins. But if you want to get the best mortgage, that's just it, because that's all that success does. You guys don't. Yeah. You don't have checking accounts. You don't have savings deposits. You don't have a vault in your office and all that kind of thing. All you guys do is mortgages. And I remember when I was doing a lot of wholesale business through Stearns lending, it was I tried to put every deal I could through there because I knew that it was going to always close. It was going to everything was going to work like a charm. And so, and that's something that I can say that there are very few companies that can, hit that high of a level of quality in the mortgage business. It's hard, sometimes there's a lot of steps. I don't know how many steps there are, 168 in originating a loan, but my goodness, something goes wrong along the way, you've got to be able to fix it. So I just love the fact that you guys are the size that you are, because it's a much more hands-on, that loan officer is responsible from origination to closing. He doesn't exit the process along the way. He doesn't have trouble if he wants to call an underwriter and ask a question about a file. He's not going to have to send an email that'll get answered 3 days later and that sort of thing. Can you talk a little bit about, Shaun, about your, just from an operations flow, you guys are able to get deals done pretty quickly. What's the hierarchy? What's the structure, the management structure? Why is it you guys can get deals done faster than other people?
Yeah, so I think a lot of it is we're making sure that first of all, we're going to give, a fast no instead of a slow yes. If we're going to do something, we're going to say what we're going to do and we're going to do it. And I think that's culturally something that I think is put together by the business itself and who's working at the company. My ops team I've worked with for, 14 years. They've been with me, and they're the core leaders of this business here. We've got all of the tech in place with Fannie Mae and Freddie Mac. We have the ability to do a VOI or a VOA, which are verifications of assets and income up front with electronic ping post. So we can get income cleared very quickly and assets cleared very quickly. We can pre-underwrite for our pre-approvals, so we can literally put everything in and get a clear to close on a file that we don't even have a property on if we wanted to. given the specs by the consumer. Obviously, we'd have to touch that up before we would close, but the core approval would be in place for the consumer. And as far as the process flow, we have the apply now links, so we can connect with a realtor, get connected to the consumer. They can put in their basic info. We have a follow-up call where we touch that information again verbally and make sure everything was understood and put in the application appropriately. And from there, we're pretty much ready to go. Once the contract is signed, we'll have an appraiser out there within 72 hours. And largely at this point with the title and how that works, we're very quick to get that back and the decisions made, and essentially waiting from there. We have many different products, so we can move the customer to a product that fits their income style. If it's a non-QM, we're doing all of these in-house. We're fortunate to be partnered with Kind and Glenn Stearns and all of his relationships. So whether we're going to HUD, USDA, VA, if we're Fannie Freddie, if we're going non-QM products, we've got it all internally for the most part. We do work outside of our core products for some unique properties, condos, things like that, or other statuses that run outside of the Fannie Mae Freddie Mac guidelines. But the process flow is done very well, and then we get to use a lot of the departments from Kind. So our capital markets, licensing behind the scenes, our compliance is phenomenal, and we're also fortunate to have deep relationships with our AMCs nationally. I know, Glenn participated in AMC for many years. TriMaven, we use them. TriVerify for our 4506s and all of our verifications of documents. We get them back very quickly. Again, Glenn's very vertically integrated within the space, so we have access to a lot of things that move us along really quite well, and we get great service levels from our partners. And sometimes you can't control those unless you're partnered with them too, to some degree. And they're all done appropriately and compliantly, but we do get great turn times from them to get the information back.
Yeah, and real quick here, you mentioned something earlier in the show, Shaun, about a program that was just introduced and rolled out for the benefit of the consumers. It's a $1,500. How is that? Explain that to us again, just for the benefit of those who are interested in looking for a loan now.
So the $1,500 can be used it's used as a lender credit. We show it on the loan estimate, and then again on the closing disclosure, you'll see the $1,500 credit, and that can be used towards your appraisal, credit fees, any fees that are involved in combination with the transaction, title fees, any of those other costs. If there's a lender cost related to flood certs or anything like that, that would be listed as a fee on there. So if you partnered that $1,500 maybe with a small seller's credit, and you put together the loan that way, you could almost give the customer what we call a no cost loan, and that would help somebody get into the house with a lower amount of funds. But if you had a move up buyer, it's $1,500 off. So it's $1,500 less they'd have to bring to closing, or $1,500 less they'd have to finance. People will say to me, "Well, gee, Shaun, it's only $1,500. I'm buying a $300,000 house." Hey, give them, $1,500 is $1,500.
You're absolutely right. I mean, the single biggest impediment to home ownership in this country for first-time home buyers is a down payment and closing costs. So cash is king. Yes. And now we're starting to see seller concessions kind of come back into the market and become part of the normal course of things. But still, for the lender to be able to add that in, and remind me again, how does that show up on the closing statement? Is it a credit from the seller, or are we just removing certain costs off the origination?
So we don't charge an origination fee, but it's a $1,500 credit. So it's what we call a EXP's Buyer's Best program. It's the best for an EXP list agent or buy side agent. That's the qualification compliantly, and it just lists right there, $1,500 coupon off, Buyer's Best, and it applies to any fee. So any fee, if they want to add discount points to lower the rate further, any way
Okay.
they want to use it.
Does it count toward the loan limit concession allowance, like say 3% on conventional or FHA or 6% or whatever the number might be on the particular type of loan?
So in most cases, it cannot. The customer still needs to demonstrate that they have those funds to close for those product parameters. So in the case of a 3.5% on a government loan or 3% on a conventional, but it does count. Most of these products have a maximum amount of concessions allowed. So
Yes.
it would apply to that as a maximum amount of concessions. So it'd be 1.5% from us, depending on the LTV. You can go to 3 or 6% in total concessions to cover the
Yes.
closing costs. But if you were doing a VA 0% down, you're still going to have title fees, and you're going to have other, obviously brokerage fees and other fees involved that it would apply towards any of those fees.
Right.
So,
So they could
it's their
potentially,
money.
yeah, they could potentially get a check at closing if they paid for their appraisal. If they wrote a check for it ahead of time, that's paid POC. They could potentially get that money back then on a VA deal or any FHA deal at closing. That it's like I said, when you're a young family trying to understand what home buying is, boy, you get shocked. I mean, the cost of the move, the furniture. I mean, it is even the window coverings when you're buying new homes. People don't ever budget those in. So $1,500 can mean the difference between you sleeping with no drapes on your windows and having them covered at night. So it is a big deal, especially to that part of the market. That's really great, Shaun. Well, Shaun, I this is crazy. Can you believe it's
Looked
that
at the time, yeah.
I know it really
Yeah.
is. Shaun, we've reached the top of the hour here. It's hard to believe. This really just flew by, but I'm so excited to have you on the show. C3 and I talked about this and been looking forward to it for a good while now. And
Yeah.
we really appreciate everything that you do to help us, serve our clients better, and just to be in business with people of your caliber and obviously Glenn Stearns and your whole crew. You guys are first class, and we are so excited to be in this venture with you together. So if anybody wanted to reach out to you, maybe there's a loan officer there that's really solid who didn't know about this opportunity, what's the best way for someone to reach you, Shaun?
Go to successlending.com. We have a great site. We have access there. There's a way to ping us there. They're welcome to, look me up or call me on LinkedIn or my email, Shaun.Patrickus at successlending.com.
Okay.
But we're on all the social channels. Just look us up and it'll get to me if anybody's interested. We're looking for the right folks.
Yeah, how many more are you looking to bring on, Shaun?
So it's interesting. A lot of these companies have these voracious appetites to hire, and I think what we want to do is we really want to align with teams throughout the country. So there's about 80,000+ agents at EXP in the U.S., and it'd be great to capture 1 out of every 10 loans or more. We've seen our best bet when we work with a team, at EXP, and so we'd love to have every market in America. What we don't want to do is hire so many originators that we start to see diminished average volumes funded. So we want our folks to be professional. We want them to be full-time originators focused on this as a student of the industry, and love to see them, funding 6 to 8 loans a month consistently in everybody we bring on. So I guess to give you the quick math, we've looked at 400 nationally to keep up with EXP, but I think in our plan we probably want to get to about 140 by the end of 2023, and that would get us, following the plan. We're licensed in 38 states with 4 pending, so we'll be in 2. There's a few states we need a brick and mortar office that we just haven't found the right person to make that investment. But I think, as we do, we'll be in all 50 states, and excited to partner. We're going to partner on Core Home, which just rolled out, which is obviously national and international. So, we'll be fielding a lot of that work through KV Core on the internet, leads through there. So we've got some big ideas. Glenn Sanford and Glenn Stearns don't leave it all up to me. They've got some big initiatives going that will help us along the way as well.
That's
Yes,
so
it,
exciting.
I wanted
is,
to think-
it is exciting. Yeah.
I wanted to say thank you for the kind words, and I don't think we can depart without mentioning the Cowboys, right? They just
Oh,
they just
yes.
made their next step.
Yeah.
Yes. First
Yeah.
time since 1993, the Cowboys have moved on past the first round.
Yeah, some people mistook that for the second coming of Christ. It's not quite that good, but it was a big win for the Cowboys. And our own Trelvis Giles is. Do you have a prediction, Trelvis, for San Francisco? That's going to be a different storm, huh?
Tough one.
Yeah. Travis can't hear us today.
Oh, he can't hear us? What?
No.
Oh, yeah,
he
he
can
can.
hear us.
Oh,
Okay.
okay. All right. We were just looking for your prediction for
the-
San Francisco.
For San Francisco, I will say that we'll win. That's as much
it?
as I'll put on it.
One for the Gipper.
We're gonna have to
Okay.
dance in the rain
Yes.
for sure.
Yeah, definitely.
Yeah.
All right, Sean. Well, thank you, sir.
Yes, thank
we're
you.
going to let you get back to business there in Schaumburg. It's great to run into you again here and have you on the show. And we'll be in New York. Are you going to be in New York next
For
week
the
for
Inman?
Inman?
Yeah, I'm going to miss on Inman, but I have a great time there. It'll be a great event. I may be at the Builder Show for anybody that's going to Ibis in Vegas at the end of the month. I might be with some builder partners, but not in New York. So enjoy.
All right. Well, we will. We'll see if we can hold the city up together without you there. I'm sure we'll do okay. But in the meantime, we won't be doing Cliff's Notes next week because we will
Yes,
be out
we
of
will
town.
be. We have a special episode with AJ Maida on Friday.
It's on Friday.
Yeah,
Not Thursday.
Thursday is
Yes.
no go, and Friday is
That's
on.
right. All the way from Puerto Rico.
Yes.
Our dear friend AJ Maida, one of the top builders here at EXP. We're so excited to have him on the show. C3, thank you.
What
man.
time is that
It's been
episode
great.
next Friday?
It's
Is
going to
it
be at 4.
3 o'clock?
I think
Or is it 4?
It's 3. I think
3 o'clock,
Central.
yeah. 3 to 4
you're right.
p.m. Hope to see you guys there. It's going to be a great show.
That's right.
Thanks for tuning in today.
Same Cliff time, same Cliff channel. On Cliff's Notes.
All right, folks, tune in to Cliff's Notes every Thursday at 1 o'clock Central for the tips, tricks, and tactics to explode your business.